Oh, 3 minutes. 3 minutes to our start time.
Good morning, Trustee Wabi.
Try him again.
Good morning, Trustee Wabi.
Good morning. How are you today?
I'm all right. Can you hear it just fine?
I can. Let me turn up my sound a little bit. I'm gonna put my headset on.
Can you hear it just fine, Trustee Wabi?
Yes, sir.
All right. Did you receive the documents?
Yeah, I'm trying to bring them up. I went through them last night on my phone. Here they are. Yep, got them here.
All right. Can you please keep your mic muted until you need to speak?
I'm sorry, say that again.
I said, can you please keep your mic muted until it's your turn to speak?
Yeah, absolutely.
Good morning, Trustee Evans.
Good morning.
Can you hear it just fine?
Excuse me?
I said, can you hear it just fine?
Yep, I sure can.
All right. Did you receive the documents?
I did.
All right. Can you please keep your mic muted until you need to speak?
I will.
We got 4, 5 out of the 6. Good.
Oh, hey, Brad.
Yeah.
Good morning.
Good morning.
Nick Azisson texted me this morning early saying he would not be here.
Oh, okay. Thanks. Then it's early for you out there in California, isn't it?
Yes, it is. It's still dark.
Are we okay?
What I do for sores, though, you know?
Yep. MSD appreciates the sacrifice.
Problem.
Okay, we are ready to begin. Trustee Watson, we are ready when you are with the audit committee.
Yes, good morning. Thank you, Brett. Welcome to the 240th meeting of the Audit Committee, Tuesday, June the 2nd. May I get a roll call by the chair, please?
Yes, the record will reflect that trustees Kistner and Carrington are present in the room, and trustees Watson, Wabi, and Evans are present online.
May I have an approval of the committee meeting minutes, March 31st, 2026, please?
So moved.
Okay, second.
Second.
Thank you. There are no comments by the chair. Then turn it all to presentation of the report, review of the payroll function. Good morning, Todd.
Good morning, Trustee Watson. How's everybody doing today? So we do have a report on a review of the payroll function. So let's move to slide 2. A little overview. The district's payroll function is administered by personnel in the district's human resource department. Currently, HR has 5 employees that work in the payroll section of the HR department. It's supervised by the assistant director. You have 2 specialists and 2 generalists that work on the payroll on a regular basis. The payroll team utilizes a system called UKG Ready to process payroll. The system is considered a SaaS, which is a software as a service. We have a couple other systems like that. Oracle Fusion, which is a GL financial system. We have VXCIS, which is through Vertex. That's a billing system. I'll talk a little bit more about this on the next page. The system is provided and supported and maintained by UKG UKG stands for Ultimate Kronos Group. It was formed in 2020 through a merger of Kronos Incorporated and Ultimate Software. Now, Kronos has been around a long time, since the 70s. Ultimate Software is started in the 90s, so that was a little more recent. The system was officially implemented and rolled out as the district's sole payroll system April 1st, 2024. Now, the prior 3 months to that, district ran its old system simultaneously with this new system, obviously making sure we're getting the right answers, so to speak, through the system. There was a lot of programming that went into getting the system up and running. They needed to tailor it to the district's requirements. IT assisted with that and worked with UKG. So when we did the audit, we were actually wanted to do it a couple of years ago, but we wanted to wait until the system was up and running, and it was running for a solid year. So we waited a little longer than we normally would. So if we go to slide 3, just a little refresher regarding how the district has moved away from the on-site systems to cloud computing. Now, these systems are completely supported by third-party service providers, other than some programming assistance from IT. You can see the slide there in the middle. UKG Ready is one of those. Again, the billing system, our Oracle Fusion system, which is our financial GLO system. We're moving more to this cloud computing. I've talked to you about this before. Any questions? Slide 4. Now, each payroll period, employees enter their time into the timesheet module. All payroll time is reviewed and approved by the employee's direct supervisor. The system routes it to the supervisor. Now, all employees basically have some form of access to this system. Now, each pay period, the payroll team performs processes to ensure the time is entered accurately and completely. They prepare analytics, recalculations, adjustments, and everything needed to fix the information before they actually release it. Now, once completed, the team closes the pay period, submits the pay period in the system. At that point, UKG personnel take it from there. They actually do the processing within the system. Now, UKG personnel process the payroll tax filings, the payroll tax deposits. They do. Now, all payroll-related funding is drawn for the district's payroll bank account. It is a ZBA, which is a zero balance account. It is funded by the district's operations account. So this process is somewhat automated. Now, Treasury and accounting monitor the bank accounts, and they monitor the funding process. So there's additional personnel involved in this. Slide 5. The scope consists of a review of the district process and controls used to perform the payroll function, along with a review of actual transactions. Now, the scope here for the transactions was 12 months, 4/1/24 through 3/31/25. So that was the first full year of the new system. Slide 6. So our overall objectives for this engagement were to ensure the process and controls are adequately designed and implemented. We want to make sure there's proper separation of duties, no process gaps or control gaps, make sure that controls and processes are operating effectively and efficiently. Make sure the payroll-related transactions are processed properly in an accurate and complete manner. Calculations, inductions are accurate. The rates multiple by hours are accurate. Calculation of the overtime hours, calculation of overtime rates. That's where we did have an issue, and we'll talk about that later. And that area is fairly complicated. I'll explain it later. I want to make sure we're obviously paid according to the approved salary schedule. The hours are appropriately reviewed and approved. Tax filings and deposits are timely and accurate, and so forth. Now, slide 7. Want to make sure assets are adequately safeguarded and not misused, not misappropriated, no unusual payments and so forth. Want to make sure overtime is paid out to the appropriate positions as outlined. That should say board-approved classification plan. You guys, the board actually sees the classification periodically throughout the year when they have to update it. They may retitle a position, they may delete it or change a position and so forth. But the classification is attached to that, or it says who's eligible, who's not eligible for overtime based on position. Go to slide 8. So methodology, how did we go about this audit to accomplish our objectives? We did our normal walkthrough process where we meet with the process owners several times to go over their various areas. We did Went through the different areas. The big area obviously is the general payroll processing, basically from time entry through all the way to the point someone gets paid. We kind of walked through that step by step several times, from cradle to grave, so to speak. We did obtain and review documents such as union contracts, classification ordinances, policy documents, job aids, SOC reports for UKG. I talked about the SOC reports at the last audit meeting, kind of explaining what those are. Any questions? Methodology, continuing to slide 9. So we did some substantive testing. We obtained imported data into our data mining software and analyzed and tested the data for the entire scope period. We imported the HR master, the payroll detail, the payroll bank detail, the HR master change history files. We did a lot of testing on this using our data mining software. We probably had 40 different tests. They kind of fall in different categories. I would say, we're looking for anything unusual, anything unexpected, anything missing, anything calculated inaccurately, anything that would look excessive, anything in duplicated payments, any duplication in there, anything like that. So once we finished all that testing, we performed follow-up investigative procedures for the items that we identified through that testing. This was fairly time-consuming. It's kind of like draining the ocean, but it did work out well, I think, and it was worth the effort. And we appreciate HR's patience through this process. So as we were doing this, we started to notice issues with weighted average overtime rates. When we saw that, so we started manually testing these individual transactions and recalculating the rates by using a spreadsheet and time cards. Now, the spreadsheet was actually provided by HR. They were seeing the same thing, so this is not new news to them. We actually modified it slightly to suit our purposes. So if you go to slide 10, as to the overall results for this audit, we do have a satisfactory opinion, but in regard to item 1, payroll programming issue, the compensating and mitigating controls allow for the issuance of a clean opinion. So in other words, the extra processes and controls implemented by the payroll group are compensating for some deficiencies that exist in the system right now. They need to be fixed. Our second item has to do with the HR master. It's more of an administrative item. There's some classifications that are wrong in there regarding exempt versus non-exempt. Any questions? So we're on to item 1. This is probably the bigger item. I'll try to.
Hey,
Yes, sir.
I'm sorry, I can't hear, or I don't know who was going to ask questions. I was going to quickly ask. On the exception 1, was there any fiscal impact of this rate calculation error?
I'm sorry, I didn't quite catch all that. Was there what kind of impact?
Fiscal. Did we spend more money than we were supposed to, or not enough money, or?
Well, as far as
or overpaid?
the errors were both directions. We overpaid and underpaid back both directions. The rates were incorrect. I would say what I saw, the largest I saw was like a difference in the rate was like $3.50. It was mainly small, $3.50 and under, but it was ranged back and forth. But I think the bigger thing is we're spending more time on this effort than we should have to. Payroll spend a lot of time having to go back and fix this, and proactively they have done a lot of extra procedures to make it work. And I'll explain this a little bit here on this next slide.
Okay.
Does that make
Todd,
sense?
if I can pause you for a second. Obviously, the overpayment is a concern, but if there's an underpayment for overtime, what's that risk look like if there's an underpayment to someone's overtime?
We
because of
have
those
to take it
calculation
back
errors?
out of the next, we deduct it from the next check.
These are all corrected.
Yeah, they're all corrected, they're all corrected
Okay.
in one form or another. I'll explain this a little bit more when we get in this next page. We had to do some off-cycle payrolls to make some corrections, to make payments. And then where they owed us money back, then we had to deduct it out of the next payroll deduction.
So I have a couple questions about
Sure.
that. You mentioned in the neighborhood of 350 or less.
Yes.
Is that per hour multiplied times a number, many
Yes.
hours, or?
Yeah, say 8 hours or something like that. The biggest difference I saw was like $50 or $60 on a check.
And do you have, or will that be part of the presentation, to know what the overall overage and underage
I don't
were?
have those dollars now.
Tad, these
Can
were,
you give us a ballpark?
Yeah, because that would seem to be important in understanding the scale and scope of the deficiency.
Yeah, we had to go back and pull that together. We could do that, but yes.
and what was the time frame that these were corrected was quick, correct? I mean, these were corrected next payroll?
Yeah, well, as far as, yeah, with, when the mistakes occur, well, originally, it took a little while to identify what was going on. Once they identified what was going on, they had to go back and make the corrections.
Okay.
And then moving forward, they've been heading the problems off at the pass, so to speak. They've been fixing it before it goes through payroll. They go in the system, they redo the calculations, correct the rate, and then they submit the payroll. So
So this is an ongoing problem that it's happening every payroll period?
it's happening when the employee works on a holiday. Only when an employee works on a holiday. I haven't explained that yet. It's on the next page, but on this page here. Basically, it's when an employee works on a holiday. For some reason, let me explain the rest.
Okay.
It'll make more sense when I explain the rest of it. I appreciate your patience. So again, when we were testing the payroll transaction, again, we noted that some of the rates were not being calculated accurately. It was system error. And we did some additional testing, and we had some confirmation from HR that they were seeing the same thing. This has been going on for a little while. What we determined, and what they determined as well, and we saw the same thing. Anytime an employee works on a holiday, which we have a lot of, every holiday we have employees work the holiday. It's operations personnel. We have to keep the pump stations, we have to keep the plants running. They're always working the holiday. That was the trigger. So let me go to slide 12 to explain a little about what we're even talking about here. We're talking about the weighted average overtime explanation. So slide 12. It's known as blended overtime, and this is not something we came up with. This is the federal mandated guidelines per the Fair Labor Standards and Act. This is per their standards. So when an overtime eligible employee works multiple positions or shifts within the same work week at different pay rates, basically, which our employees do. There's 3 different shifts in operations. And then sometimes they'll work different roles as well. A good example, a treatment plant main operator may work also as a treatment plant team leader. So that's a different pay rate when they do that. So you have different shifts, you got different roles, which makes it complicated. So instead of paying multiple overtime rate amounts, the employee determines a weighted average for that week, determine a single overtime rate amount for the week. Now, to further complicate matters, this single overtime rate amount may have to be added to multiple base rates if the employee works overtimes in multiple shifts or in multiple job roles. So it gets fairly complicated. The programming can get complicated, but it still should be right. So I hope that makes sense. So again, the errors started rising when the provisions of the most recent union, originally the system was working fine when it first rolled out. Errors started rising when the provisions of the most recent union contracts were put in place in July of 24. The provisions of the new contract switched from daily overtime to strictly weekly overtime. And that's due to the new flexible schedules for certain employees. It also corresponds with the federal guidelines. The new flexible schedules, you look at the top corner, I'm on page 11 here. You see the new schedules, the new flex schedules, the employees are actually scheduled for more than 8 hours a day in their schedule. So if we didn't change our overtime approach, we would have been paying overtime just for employees to work their normal schedule. You can see some work eight and a half hours, they work 9 hours, over 10 hours a day. So now it's based strictly on 40 hours a week. So what happened, it appears the system program did not adequately account for this change in the overtime calculation methodology. And that's when the errors started appearing. And it only appears when they work a holiday. And the errors, again, go both directions. There have been several service requests that have been submitted to fix with no results submitted to UKG. So again, in order to correct or fix the prior parallels that contain these errors in the calculated rates, the parallels before the identification of the issue, they had to go back and issue what they call off-cycle payroll. So that's where they had to go back and pay them extra. Now, for the ones that had to recoup money, they had to make adjustments to the actual payroll for that person and deduct the money. Does that make a little more sense?
It makes sense, but it's still,
Yeah.
my original question I kind of still have. As you're looking at two things that you mentioned in here, number one is obviously when there was a change to the recent union contract. How is this impacting potentially that CBA? But then the second part would be the FLSA standards as well, if people are being underpaid, right? Yeah, you can make an off-cycle payroll to fix it, but does that open up the organization to any type of additional risk from complaints for FLSA for someone being underpaid?
I'm sorry, can you speak up?
I have a mic now. Can you guys hear me better?
Yeah.
Okay, awesome. So the error happens when a holiday falls at the end of the pay cycle. So it's not every holiday, it's at the end of the pay cycle. UKG is aware of this. We've had a ticket with them since July of 25. So they're aware of this particular error. What we do internally, and that's what Todd was explaining, is that it does require a lot of manual intervention from the payroll department to prevent this error. We are in compliance with FSLA law. We are making sure that in the occasion, if it's, because sometimes time cards are submitted late, so when he's talking about we back pay, we make off-cycle payments. We make sure these employees get their money immediately if there's an issue, if they're submitting or making a correction for the holiday, but it's not an issue. We're absolutely in compliance. UKG is deeply aware of it. Our IT department is working with us. But it's the Friday, when a holiday falls at the end of the pay cycle, we already know what's going to happen. And so we start working ahead of time. My staff works overtime to make sure that no employees are impacted by that. But the impact that Todd is identifying is the level of effort is huge. And it is an issue. But we've got our entire IT staff working with us. We've got UKG making it a top priority. But the CBA has very special pay arrangements that are not usual and customary. And that's what's creating issues with UKG. So it is a concern. I think it definitely needed to be noted in this particular audit, but in terms of impacts to employees or non-compliance with FSLA, that's not happening. Did that answer your question, though?
No, you did. Thank you.
Okay, yes, Mr. Trustee Wester. Oh, yes.
Trustee, can you turn on your microphone?
Sorry about that, I just turned it off. It doesn't seem like it is a priority with UKG if it's been out there for almost a year.
I think that is a very fair observation. I can only tell you that we've been escalating consistently. Myself and Jenny, Jenny Kinstra, who is the director of IT, we've definitely made this a priority. So they're working on it. I do agree with you. I feel like in the scope of priorities, it could be higher. But I think the issue from UKG standpoint, which again, our CBA created some pay cycles that just are not usual and customary. And the only error is when the holiday falls at the end of the pay period. If it's in the middle of the pay period, at the beginning of the pay period, this doesn't happen. So I agree. I think the ticket's been out there for quite some time. I think that's why it's fair that it's noted in this audit. But we've made manual interventions to limit impacts to employees. But this is, as Todd already mentioned, a system issue that has been ongoing since implementation.
Okay, I mean, it does sound like there's a lot of waste involved because of the manual efforts to address it.
Yeah, I would say that in terms of payroll impacts, even if with my staff doing overtime and things like that, we've minimized those to the greatest capacity that we can. Not every employee, just to give scope, works the last Friday of every holiday that happens. So it's one thing that we know that's going to happen. I would say the number of employees that are impacted are small, but nevertheless, it is an issue, which is why it should justifiably be noted on this audit. But again, I can promise you guys we are in compliance. It's just that the manual effort is what Todd is noting and should be noted in this particular audit.
And can I assume there's no estimated date for resolving?
That is correct.
I guess I was told that they expect to have an update this month from UKG.
Yeah.
And
we've been hearing that.
we're going to continue to monitor, and well, I'm sure they're going to monitor as well. If we can circle back and let you know what we find out and see if they have made some real progress. I agree with you. It should have been fixed a long time ago. That's kind of one of the reasons we wrote it up. I'm like, why is this not fixed? That was my thought as well.
Thank you.
Let's see. So, all right. I think we kind of explained that. So again, I guess they went back and did all cycle payrolls and so forth. So let's move on. Slide 13. So again, what they're proactively right now. Again, they're running a report that identifies all employees with time coded holiday worked. So they look at that. And then based on that, they'll go back and check the rates on all the people with time coded to holiday worked in their pay card. So if they have to manual recalculate and make the correction in the case of where there are errors. So again, as I mentioned, the procedures are encompassing. They have, again, we have 12 holidays per year. That's 12 out of 26 pay periods. In our 12 months, we saw 171 instances of holidays worked by 77 different
So real
employees.
quick, Todd, those, when we uncover these, when Tracy's people see these coming, the district has to spend overtime on the tasks to get everybody else paid because the system doesn't work. Is that correct?
I'm not sure I catch all that.
Yes, that's correct. He asked about overtime. So there's overtime
Yes.
every time they have to work to fix this.
And that the numbers, and I guess this may not be for Todd, but I mean, are we going to the contractor and saying, hey guys, you're in breach of this contract. It's requiring us to spend extra resources. Are we deducting the payment from the payment for whatever the subscription is?
We've received service credits from UKG for that. Again, the overtime that the department is spending is not super substantial. What we've done is we ask for time cards to be submitted early on the holiday week so that there's time to process and make those particular changes. Because again, we know it's coming. I mean, we know when that Friday,
Right.
We know when it's pretty predictable. When you know that the holiday is going to fall on the last week of the pay period, that's kind of easy to figure out per year. Again, it's not every single holiday. We have escalated these concerns, like Trustee Kistner said. It is inconvenient. I mean, that's not something that I think they should be minimized. But the processes have been early submission to lower overtime. Staff is doing that mostly during daytime hours. It's really only affecting the shift workers. So it's not every single employee, but it's the shift workers with the special CBA arrangements when the holiday falls on the second week. So when those stars align perfectly, we do know that's going to happen, but we can predict it way ahead of time. And the amount of overtime that my staff has spent has been minimal because we asked for the time cards to be early on those particular days.
Thank you.
Just to kind of build on that, I just want to understand, I hear you saying that obviously as part of the contract, there's service credits that are offered. What does their SLA or even potentially indemnification look like for this, if this becomes a bigger issue? I mean, again, this is a year old at this point, and if the only thing they're offering is service credits, is that truly sufficient?
Based off of impact, I would say yes, because the impact is small, but the reason, again, that I think it was absolutely needed to be put on the audit is it is deeply inconvenient. So we've got these workarounds. UKG believes this is going to happen soon. They've hired a developer to work on those particular changes to get that going. So my concerns are small, but again, I think it was absolutely required to be noted in this particular audit because it doesn't happen that frequently. But that's why the overall rating for us was a successful audit. But again, it's just a lot of intervention to get that done. And they are working on that. And those things have been brought up in terms of the contracts that we have. And they have been meeting the requirements of their contract by providing those particular service hours in exchange for the inconvenience that's being created. Did that answer the questions? I wanted to make sure that I answered those.
Yep.
And I know we're still in the middle of discussing this, but because this is an ongoing problem, a sort of unknown scope, because we don't have a lot of dollars, put on these, either how many overtime hours are required to fix it, ongoing over the course of the last year, the amount of overages and underages, if that's a word. Can we get an update on this at some date in the future so we're not waiting for the next audit cycle to know how this is resolved?
Yes, and we would normally, we follow up on all these every year anyway, but I'll give.
And that's why I'm saying, let's not wait
I got
a
you.
year.
Yeah, well, I'll give you a specific update on this, where we stand.
Thank you.
Maybe we'll combine efforts with HR and we'll give you an update. And we will do our annual review as well, as follow up on our recommendations.
Trustee Kistner will have more information once this developer has been hired in June. I was not promised a resolution in June. I want to be very clear about that. But UKG has hired a special developer to work on this. We should have more information updates as the month of June progresses to see what's going on, and I can promise something could be brought back to the board.
Okay, thank you.
Thank you. Appreciate your time.
Okay, any more questions? I think we're going to move on from this one. I think we've covered everything I need to cover. All right. So let's go to the second item. This is a little less complicated. More of an administrative item. So one of the things we did is test perform a test of review for employees who were exempt or not eligible for overtime, but despite the exempt classification, did receive overtime pay. When we did that, we identified 7 employees who received overtime pay despite being exempt per the HR master. Now, what we found after some additional review and investigation is that the classification in the HR master is incorrect. The payroll system was correct. In other words, per the ordinance with the task classification plan, those positions are actually eligible for overtime. So again, the error is in the HR master, which is not driving the payroll. But you don't want to create confusion by having the wrong information in the HR master. So we're recommending that management go through the HR master and kind of do an analysis like we did and look for, compare it to the classification plan that is actually part of the ordinance and make sure they make any corrections they need to. And check this, periodically. I think they've actually had staff who's going to do some checks when they actually enter the information to make sure it's entered correctly from the start. So I believe they've already made some corrections. So I think we're in pretty good shape on this one. Any questions on that? That's all I have. So we will definitely bring you an update when I'll stay in contact with HR and let you know what we hear back from UKG. And I think it's a good thing that we stay on this, and we'll give you an update. Appreciate the time. Any more questions or anything else? Thank you.
Well, thank you, Todd. Next meeting tentative date is June 30th, 2026. Can I get a motion for adjournment, please?
So moved.
Second.
Second.
Meeting adjourned.
Okay, we'll get program management set up here, and then we'll be ready to go.
Check, check.
You okay, Glenn? Okay. Trustee Kistner, we're ready when you are.
All right. This is the 278th meeting of the Program Management Committee on Tuesday, June 2nd, 2026. Can we get a roll call?
Yes, the record will reflect that trustees Kistner and Carrington are present in the room. Trustees Wabi, Evans, and Watson are present online.
All right. We have our committee minutes from our May 5th, 2026 meeting. Can I get a motion to approve?
So moved.
And can we get a second? Come on, guys, help me out here.
They can hear it, can they hear it?
If you're on mute, if you could just
Yeah.
say second. Oh, I'll second it. I have no comments, so we
Second.
Yeah, there we go.
All right.
Sorry.
We have just a couple of engineering department agenda items today.
Good morning, trustees. 2 items today. First item is the L51 pump station force main improvements. This action will appropriate additional funds to an ongoing construction project being performed by Kelp Contracting. This is a planned fiscal year 27 appropriation, so we'll introduce in June and it'll be adopted in the new fiscal year in July. The work to be done consists of construction of approximately 8,300 feet of 36-inch force main. The purpose of the project is to construct a replacement force main parallel to the existing force main, allowing for the future abandonment and or rehabilitation of the existing force main, which is nearing the end of its useful life. The installation is from our L51 pump station into the Missouri River Treatment Plant. This is a supplemental appropriation, again called out in the fiscal year 27 budget. The original appropriation was $4.7 million. The supplemental appropriation is for $8.3 million, bringing our total appropriation for the project to $13 million. Are there any questions? All right, our second item is the Claymont Storm Sewer Improvement Project. This action will appropriate the funds and authorize staff to enter into a construction contract. The work to be done consists of construction of approximately 150 feet of pipe sewer 18-inch in diameter. The purpose of the project is to alleviate yard flooding. We've received 4 bids for this project. The low bid was from Gardner Contracting. The low bid was below our designer's estimate, and our appropriation of $150,000, which includes utility relocation and contingencies, is below the original planned budget for the project. Gardner Contracting is committed to just over 20% MBE and WBE participation, which meets our 10% minority and 10% women goals. I will note too, this will be our second project funded from the new Stormwater Capital Program. I think coming up this week or next week, we have the groundbreaking on our first project. So You'll start seeing a lot more of these in fiscal year 27, but we're happy to report that. So with that, that is all I have on the agenda. I am going to say this is my last program management meeting because I am retiring at the end of the month.
Really?
So been doing it a long time, so I'm going to quote our past board chair. It's been the pleasure of my life.
Congratulations, Rich. That's fantastic. And it was a short one.
It was.
Didn't make you do the long.
The next one will be longer, but somebody else will be doing it.
All right. Do we have any other business? If not, our next tentative. Go
I
ahead.
just wanted to say, hey, thanks, Rich. Enjoy your retirement.
Thank you very much.
I'm sure you will. Our next tentative meeting date is June 30th, 2026. And we have do we have a motion to adjourn?
So moved.
Don't move.
All right. Thank you.
Okay, Trustee Evans, we'll get a Finance Committee set up here and let you know when we're ready to go. Trustee Evans, we are ready to begin the Finance Committee meeting.
Okay, thank you. Get a roll call, please.
Yes, we still have trustees Kistner and Carrington present in the room, and trustees Evans, Wabi, and Watson present online.
Do I have a motion to approve the minutes of the prior meeting?
So moved.
Second.
Okay. Next item is the quarterly retirement plan review by NEPC.
All right, we've got Deanna Jones and Scott Driscoll in from NEPC to give a market update and present results through March and maybe touch on April because that was a better month.
Although both months for you all were pretty solid. Good morning, everyone. Thank you for having us in. We, as Tim said, we have two kind of data points for you all this morning. We're going to go over your quarterly performance, so your Q1 performance. We also have your preliminary April performance. Maybe to set the table and kick things off, I'm going to turn it to Scott to talk about markets, and then I'll dive into the portfolio's performance.
Thanks, Deanna. So yeah, I'll give a broad update on page 4. We have an overview of the market here. This is as of the beginning of April 2026. Things have changed quite a bit. I think if we all looked at what happened in the first quarter of 2026, first 2 months looked fantastic, really across the board. Then March was really a sell-off. The conflict began. Markets definitely reacted very negatively, and we've seen significant volatility since then. And when we take a look at the various outlooks in the market, various things we're talking to our clients about, it's when markets have traded down, want to make sure we rebalance into those asset classes that trade down. Given the pension is in an OCIO portfolio, we're able to do that very efficiently and quickly, and able to do that. Also want to make sure that clients are holding enough safe haven fixed income exposure, so very liquid assets, and our clients do. We think that's very important in these types of volatile environments, as well as we want to be able to monitor the public real assets within our clients' portfolios. But that was one of the updates as of the beginning of April here, and we have a lot of information in this book here. But if we go to page 5, I just want to show you some of the performance that we did see in the first quarter, because this is in the executive report. And the first quarter really either flat or negative across the board here. When you look at this chart here, the global equity markets, that's measured by that MSCI equity benchmark. It's in negative territory. Your S&P 500 is in negative territory. Really, the only place we saw positive performance within the equity markets was your small to mid-sized stocks, that Russell 2500. Not surprisingly, if you go across the page here, this goes across the various benchmarks within the fixed income markets. Commodities really jumped through the roof. Commodities up over 20% when we look at that Bloomberg commodity benchmark. Since the conflict started, we've seen, really the energy prices starting to accelerate. I think anybody who's gone to a gas pump over the past number of months, we've seen it jump, anywhere from 40 to 50%, recede a bit, and then jump. So there's definitely been quite a bit of volatility there. And I think when you look at some of the performance numbers, one of those, that tube on this page right here just shows you how significantly we've seen certain parts run in various periods. Another page I want to touch upon, actually, go to page 7. This is really this risk asset sentiment, deteriorated in March, goes to what I was talking about, where the first 2 months, that's that dark blue tubes on the chart, were positive really across the territory, across the broad market. And then the last month of the first quarter was negative. That's that much lighter blue here. And it was really risk assets that pulled off. Your long-only equities that did extremely well over the past, honestly, 18, 24, or 36 months, depending on which asset classes, pulled back significantly. But I want to now say, when you look at this March chart, we also have April data in our presentation for the plan. Things have changed very considerably since we saw this huge sell-off in March. The markets have reversed quite a bit within the long-only equity markets, as well as fixed income has posted some modest results over these various periods as well. This gives you an illustration of how drastic of a reversal in performance we saw just over a 2-month period relative to a 1-month period here. And if you go to page 8, maybe this will be one of the last pages I hit upon on broad markets here, but this is growth. So when we look at what has driven the markets over recent history, it has been your growth stocks. So it's been technology stocks. And when we look at the difference between growth and value, this first quarter is actually one of the larger quarters we've seen in ages, where there's been a very significant difference, and value outperformed. It was great. We use value in a lot of portfolios as a hedge to the growth positions in the portfolios. And I think when you look at the broad U.S. stock market, all these technology names have really driven the market into a growth tilt, and having value in place to offset, say, when we see extreme volatility in the growth markets has been very beneficial. We can see that when we look at the March performance report that we have in your presentation here, that you can see that value is able to offset some of the losses. I think this chart right here, kind of shows you that real wide dispersion. It's been a defensive hedge to a lot of the growth, exposure within plans. So I think maybe I'll finish it on one last page, page 13. And page 13 goes to the OCIO portfolio positioning. So the positioning of the overall plan, where we have strategic tilts, where we see tactical tilts across, these broad asset classes, equity, credit being fixed income, and then what we consider safe haven, high quality. That's your very high quality fixed income. And I really just talked about that value tilt because core equities have become very much growth centric just based on what is in those technology, the AI names, have taken your, say, S&P 500, your core benchmarks, and pushed them very much into growth territory. We want to make sure we have that value tilt in place, which we have within our OCIO portfolio since 2022. So we try to minimize, the drift meaning you becoming, over allocated in one style within the broad markets. And we also want to be mindful of how we're positioned globally within the markets, between the US, the international developed markets, as well as the emerging markets. So we try to take a strategic balance there. We're also tactical when we see that there may be some, opportunities, say, to hedge portfolios back to the dollar. We'll do that. But it's pretty well diversified global equity portfolio. When we think about credit's very diversified. We have about 50% in what we call high quality companies, 25% in lower quality companies, high yield, and then about 25% in these bank loan issues, which are, about as high quality as it comes. So those are, the strategic as well as tactical allocations within equity and credit market, the broad markets. And then we always want to make sure we have that safe haven fixed income exposure, which is detailed on this page. And that's for liquidity purposes because pensions have to take money out. We want to make sure you're liquid. We want to make sure you have the money to take out. So we keep a pretty good balance between treasuries and treasury inflation protected securities. Pause there if trustees have any questions.
Okay, hearing none, can we jump to page 15? So first I'll go over the performance and the complexion of the pension fund, and then we'll talk about your two defined contributions plan. This is a snapshot of where your assets were kind of mapped out in the pension fund as of March. You're within range and kind of on top of your targets for equity and fixed income. Within multi-asset, when we took over as your investment consultants, as you all know, you had a small allocation to two illiquid investments that are kind of maturing and being liquidated. One of them, the largest tranche, was the UBS real estate, a core real estate fund. They're starting to sell those assets, so you're starting to see capital come back. So I'd expect in the coming months and quarters, you'll see that multi-assets will be kind of on top of targets, and you won't have that 1% overweight to multi-asset, but still within your book range, so still within your policy. If we can go to page 18. This is a snapshot of your performance relative to peers. So for a refresher for the 10-year trustees, new information for the newer trustees, we kind of look at the portfolio through three different lenses, if you will. The first one is your actuarial rate. How much does your actuary say you need to meet in order for this plan to be successful and meet its liabilities? The next one is your policy benchmark. So what that policy benchmark helps us understand if the fund was perfectly invested in those policies approved, asset allocation policies approved in your investment policy statement, but 100% passive. How would the portfolio have performed? And that's a good bogey for us to understand how the tactical moves our portfolio team on our OCIO team are making are additive to performance, and also how active management within your portfolios, those managers intended to outperform a benchmark, have helped or hurt the portfolio for the time period. The last bogey we look at is how do you look relative to your peers? I would caveat that to say there will be times you underperform your peers. You're a closed fund. You don't have exotic things like private equity, private debt in your portfolio. Those are inappropriate for the dynamics of your investments. And so there will be times that you underperform. In this current market period where AI and tech names are representing right around 40% of benchmarks, and you're seeing a lot of upward movement within the equity markets because of it, you are in a good position to kind of benefit from that. So you're significantly outperforming your peers. I'll focus on in this chart are focused on 2 time periods. The first one is the 3-month period, so that's the first quarter of the year. The pensions return was 50 basis points, so positive 50 basis points. Your policy benchmark, remember that's what helps us understand how what we're doing in the portfolio is additive, was down 90 basis points, so outperforming your policy benchmark for the quarter. If you go back up to the total pension and that 4 in parentheses, that represents your peer ranking. 1 being the highest, 100 being the lowest, you're the 4th percentile. So high performance, significantly outperforming your peers. If we go over to the 1-year period, which is roughly representative of the NEPC investment return since we took over as your consultant, the fund has returned 14.6%. So positive performance on an absolute and relative to your benchmark performance, and also ranked in the 17th percentile relative to your peers. So strong performance and also strong peer rankings. If we go to the next page, this is just a breakout or more detail on your performance. And I promise I won't read all these numbers. I'll just highlight a couple of things. So the first thing, and to Scott's point around AI, and because of the volatility within the quarter, we have built in what we call a value position. And when you're thinking about value in portfolios, think about buying a leather jacket at a garage sale and paying $100, but you know you can sell it on eBay for $200. So you have some intrinsic value in those companies. The managers we've placed in your portfolio to do that is represented by that RAFI Fundamental Select Index. That's a passive large cap value manager. The intent of that asset in your portfolio is to manage some of the volatility that exists within the market. So when you couple geopolitical concerns around AI and what that impact will be to the labor markets, concerns if AI have actual material earnings, that injects a lot of volatility in the market. So we add these RAFI positions to bring what is otherwise a very growthy portfolio back to kind of a core positioning. You see during the quarter, with all the noise and the negative numbers in the equity markets, that RAFI position was positive on an absolute basis for you and relative to the other pieces of the market, returning 2%, relative to the broad Russell 3000 index, down 4%. So that was a strong position for you. Excuse me. If we go to the next page, another piece of your equity market is the international, emerging and global market. This is on page 20. International markets kind of struggled, particularly because of their dependency on some of the oil in the Strait of Hormuz. There was a lot of struggles within the international market. One shining piece of it was developed markets, so that's represented by the SGA, MSCI, EAFE. That's a developed passive sleeve within your international portfolio. Positive performance on an absolute basis, and that kind of managed some of the negative numbers we saw within the equity markets. We're also starting to see more runway within emerging markets. If you remember, at the beginning of our relationship, we added emerging markets to your portfolio, and we were able to add it when emerging markets were kind of getting beat up. And you're able to kind of ride that up wave within the emerging market performance. Global equity, which is that bottom line, the NEPC global equity bucket, those are that's a multi-manager fund that we manage on your behalf. And that you saw strong performance there, a lot of that outperformance. So it was negative on a absolute basis, down 1%, but outperformed its index by 2%. So negative on an absolute basis relative to the broad global markets outperformance. And a lot of that outperformance was because of the strength within those value managers that are managing assets on your behalf. If we go to the next page, this is a snapshot of your fixed income portfolio. As Scott mentioned, our intent with the fixed income portfolio is to be safe haven. So when Tim lets us know he needs money, this is normally our first source of liquidity for you, particularly in distressed markets. That portfolio positive 10 basis points outperforming the broad Barclays aggregate index. A lot of that outperformance came from that diversified or return-seeking credit bucket you see at the bottom of the page. If we go to the next page, this is a snapshot of the assets that are intended to be diversifiers within the pension fund. The first piece is that Metis Real Asset Index. So that real asset index is a blended manager that, sorry, was that a question? Pause for a minute.
Trustee Watson, are you online? Trustee
I am,
Watson.
thank you.
Thank you. We paused
am,
for
thank
we paused for just a moment to get you logged back in again. Thank you. We'll proceed with the meeting.
Thank you.
Please go right ahead. I'm sorry.
No worries. It gave me time to breathe, so thank you. I appreciate it. So the Metis Real Asset Index is, you could think about a sleeve of that being that large outperforming blue bar that Scott talked about at our opening comments. So that's giving you exposure to things like gold, precious materials, some real estate exposure, so things that are diversifying the portfolio relative to the fixed income and the equity piece. The fund below, that Trumbull UBS fund, that was a fund we inherited when we took over as your consultant. It's being liquidated, so you're going to start to see that $7 million go down as capital is returned and reinvested. The PIMCO fund is a multi-asset fund, also intended to be a diversifier. So within that, you'll have things like bank loans and other asset classes that aren't captured in the equity or fixed income bucket for you. I'll skip over Entrust. That's also a fund we inherited that's being liquidated, so you'll start to see that line item go away. And if maybe I can go to page 24. For the pension fund, we have as Scott mentioned, an OCIO, or a discretionary relationship with you. And because we have that discretionary relationship with you, we are able, for you and all our other clients on the OCIO side, able to negotiate preferred rates with the investment managers that you work with. The first bucket that says fee savings, that $365,000 is how much we've been able to save you relative to the rack rate. So if you were not an NEPC client and you had this portfolio, you would be paying more money for this portfolio, but because you're an NEPC client, we're able to negotiate fees on your behalf to bring those fee savings down. Those money that goes right back into the pension fund to be invested and eventually go for pension benefits for your beneficiaries. We also conduct your operational support, so that looks like a couple of things. We hire and fire managers on your behalf. We also do rebalancing or cash raises for you. So over the course of the year, we've done 35 rebalancing. Roughly around 12 of those are to raise money to pay pension benefits at the end of the month. Some of them are rebalancing to help the portfolio benefit from either long-term or short-term market dislocations. We've done 2 legal reviews for you. So we have a legal team who negotiates all the contracts of the managers that you work with. We've done 2 of those. You will only see those happen if we onboard new managers, which we did during the course of the year. And then fiduciary oversight, we talk to your managers quarterly. We do very formal annual due diligence with managers right around every 12 to 18 months. And on behalf of MSD, we've done 59 of those meetings over the course of the year. Before I go to the other 2 plans, are there any pension-related questions I can answer? Okay. Hearing none, very quickly, appreciating I'm bumping up on time. If we could go to page 30. So this is our executive summary. It's a snapshot of the two other plans we manage on your behalf. The first one is the 401A plan. Most of your participants within that plan are invested in what's called your target date funds. So when you join MSD, they calculate your expected retirement date and they map you into a fund that is appropriate for that retirement date. A couple of, right around 20% of your participants are in other core options. Our goal and our responsibility as your consultant on the DC side is to make sure whatever options are on your menus are appropriate for your participants so that they are not negatively harmed by, let's say, going 100% into any fund. The pie chart over to the right represents the mapping or breakout of your participants in the 457B plan. Similar thing, most of those participants are mapped into the target date funds. If you go all the way over to the right, the capital market performance, we already kind of talked about that, but that just is another snapshot of the broad markets. We, at this point, have no manager due diligence, so if something changes within a manager that is an option within these two plans, we will come in and let you know and make any recommendations. We don't have any recommendations for the plan right now. On the next couple of pages, you see, and I won't go through all these numbers, but you'll just see the breakout of the number of assets in each fund, what your menu lineup looks like, how many participant assets are in there, and the performance for all of those individual pools or individual investment managers. So I think I'm at time. I'll pause and see what questions I can answer.
All right, thank you so much for
No
coming in.
problem. Thank you, guys. See you in a couple of months.
Thank you.
Okay, the next three items are all mine. So I'm going to start with Investment Management Services RFP 1521. So we recently conducted an RFP for investment management services. This was a function of the current provider's contract coming to an end soon. Been very happy with their performance. They won the previous RFP based on, size, abilities, pricing, but I wanted to walk you through kind of what we were looking for in the results of this RFP. So on the next slide, these are just kind of the main scope of the RFP. So we're looking for somebody to provide advice, secure investments, execute those investments, provide all the trade documentation so we can support our accounting, our investment portfolio. Our primary objective is safety. I mean, we're a public entity. Liquidity and yield also important, but safety first. This would be to manage both operating portfolio and bond proceeds. We don't currently have a bond proceeds portfolio because our loans are all coming from the state revolving fund right now. They would have to be a registered investment advisor. They have to explicitly acknowledge their fiduciary duty to MSD. So the partner will act as a fiduciary, obviously comply with our investment policy as well as state statutes, can't receive indirect compensation. And then we ask them just to provide information about their operations, their investment philosophy, how they could satisfy the requirements of the RFP. And then the grading requirements are at the bottom there. So we evaluated each firm that responded based on their ability to satisfy the requirements of the RFP, based on fees, and then also their experience and qualifications. So the next page is just a
Tim, I've got one question about that.
Yes.
I don't recall if this was for an investment manager or for a different consultant, but I recall in the past we had issues with some vendors adding in what I thought to be an artificially low limitation of liability clause in their proposal. I think it actually caused us to ultimately not select that vendor. Do we have any questions or any requests for information on that subject regarding the search for managers?
So one of the things that we do ask is if they have any objections to our terms of contract. And you're right, last year it was actually for actuary. The firm that won the RFP, initially we could not come to a contract because they wanted to push back on liability limits and indemnification language. So we do ask that specifically, and we went through this and asked the respondents specifically. Some did note that they had some exceptions or some things they wanted to negotiate. Others did not. So the firm that I'm going to recommend here specifically said that they accept our standard terms, what we had outlined in the RFP and our standard contract language.
Okay, thank you.
You're welcome. So next please, Stephanie. We had 7 qualified responses. These are all good firms. Range of firm sizes. The smallest had 1.3 billion assets under management. Just remember, last month we had over 700 million just by ourselves. So this firm was managing about twice what our whole portfolio was. And they ranged to really large firms with over 800 billion assets under management. Most of them fell somewhere in between there. They all had experience with public entity clients, all acknowledged their fiduciary duty with no indirect compensation. 2 of the firms did not manage bond proceeds. We allowed firms to still respond because we can potentially find somebody else to do that, but that would have added to the overall cost. The estimated fee range for the services is roughly $150,000 annually, up to $300,000. And then 2 of the firms actually have a reporting accounting solution that could reduce our costs. So right now we use a tool called Clearwater for investment reporting. We also use that for accounting. 2 of the firms use the same version of Clearwater we do and say that they make that available to their clients for the same purposes we're using that for. So if we are able to transition to their version, branding version of Clearwater, we could potentially save money by ending our contract. So that could be up to about $50,000 a year. So that's something that we're looking at as well. So our recommendation, it's on the next page, and I am recommending a change. Despite how pleased I am with the current provider, Meter Public Funds came in. Our panel feels with a better overall proposal. The panel was myself, Marion, and Jessica, who's my assistant treasurer. They have over 35 years of experience. They focus on public entity clients. They're large, 180 billion assets under management with 140 employees. That is helpful because we do sometimes see turnover in personnel, so having a deep bench makes sure that we're going to always have qualified people available to assist us. They'll do some detailed cash flow analysis. They have a tool that they like to use, so we will see if that adds anything to what we currently do. Their team is very experienced. We love their reporting tools. Like I said, it's the one we're currently using and paying for. They have robust compliance monitoring, so they can build our investment policy into the plan, which will flag immediately if we have any compliance issues. They were one of the lower fee structures. They weren't the lowest respondent, but they were the second lowest, and they would provide us savings over our current contract. So what I currently have budgeted for the next year, Meter would come in under budget, and then additional potential savings if we are able to transition to the reporting accounting tool, which we have talked to them about, and we feel comfortable we're going to be able to do that, but we're going to kind of run parallel for a while and make sure that works. So what I'm going to ask for at next week's board meeting is introduction and adoption of an ordinance to authorize us to enter into a contract with Meter. Are there any questions about the RFP or the recommendation? All right, hearing.
Do you mind if said that, what is the bid amount?
So we estimate it would be roughly $190,000 a year. I have budgeted $225,000 for this year, and then potentially additional savings from the Clearwater. So they were the second lowest proposal. Most of these bid based on assets under management, so the more investments, the higher the price comes. It's, less basis points as the dollar goes up per dollar, but still an overall increase. So that's an estimate based on a $650 million portfolio.
Okay, thank you.
So Tim, we pay these guys per trade?
We don't pay them per trade. We pay them based on total assets under management. So quarterly, we'll look at the average size of the portfolio over that quarter. Their particular proposal was 5 basis points on the first 200 million and 2 basis points on anything over that.
Okay.
Some of the other proposals
I got it.
were 4 basis points early, 3 on a higher amount. So everyone's kind of similar. We had one fixed fee portfolio, but there were other concerns with that response that kept us from recommending that firm. All right, next I move to the operating portfolio. Speaking of investments, this is the sheet we look at, new color scheme for the operating fund portfolio. But we had $638.9 million under par as of the end of last week. That is about a $93 million reduction from the previous month. That's because in May we had about $63 million of principal and interest payments go out the door, as well as relatively high capital payments. A portion of that capital is usually reimbursed from the SRF loan, but just the timing of when that invoice was paid, we haven't received the reimbursement yet. So we're expecting about a $26 million reimbursement here relatively soon, but that hasn't come in yet. So down $93 million from the previous month. Our yield to maturity on the portfolio is lagging the benchmark right now. The benchmark has fluctuated a lot. Last month it was 388. Rates increased over the month, so it was about 4%. That entire benchmark, moves with rates. Well, only a portion of our portfolio does because we have existing investments that don't move as interest rates move. But our new investments were at a little bit higher rate, so we upped from 389 to 392 yield to maturity. We're always going to be a little bit more stable. Our weighted average is still under a year, but over half a year. It's a little bit higher than it was as we look to extend some maturities and take advantage of these higher rates. The benchmark actually came down a little bit. It was 1.9 roughly. Now it's 1.8 weighted average maturities. That'll always be around 2 years since it's a 1 to 3 year benchmark. We matched the credit rating. They're both high credit quality portfolios. We have about 81 securities in our portfolio. Sector allocation, this is where we're really over in the upper right. That's really where we're measuring compliance with our policy. We are in compliance. We had a bit of a swing this month. I think a lot of the investments we had that were securing the interest payment we made at the beginning of the month were in federal agencies. So we saw a reduction there. It dropped from almost 9% down to 3.3%. Commercial paper went from, remember that one, we were just just over our limit last month at 25.1%, down to 19.4%, so in compliance. And then the difference of that's all in the U.S. Treasury bond note. So we're about 11% higher in Treasury bonds than we were last month. That's just based on value and where we're going. So especially as we extend our investment maturities, commercial paper, we can only invest up to 6 months. When we go beyond that, it's typically treasuries or agencies, and treasuries provided a better value. Fund summary in the bottom, really all the changes I'm talking about you can see in the MSD operating portfolio, which is where the bulk of our dollars was. And then we started providing that little space on the bottom there to give you an idea of just how those funds are distributed. We're always running a month behind in the reporting on this because these come from our financial statements, and we're not going to have May financial statements for another week and a half probably. But roughly half the money is in capital project fund. That's where we have a lot of spend. The special revenue fund, which is the second biggest number there, that's all stormwater related. That number, because we are now collecting on new stormwater rates starting roughly a year and a half ago, is a higher number than it has been historically, but we are starting to spend there. We'll see that debt service number go down since we just made a large debt service. And then general fund and permanent fund kind of round out what's there. But nothing looks very different than what it has the last couple of months, although we'll probably see some shift there next month since we did pay debt service and we'll see a reduction in the overall portfolio size from the previous month. Maturity distribution is comparison of our maturities to the benchmark. We're the blue bars, benchmark is the orange. We still have the bulk of ours maturing within a year, and that's because of large capital projects. The FBI, the incinerator project, still our biggest project. We expect large cash flows. We're running a little bit behind on spend there than what we had projected, so we're holding more cash short term than we thought we would be. So that's why that number is so high. It came down a little bit just because of the large payment for the debt service. Any questions on the operating portfolio? All right, and I've got one new report. This is a debt summary portfolio. So debt is really important to the way we fund the operations. And Trustee Wabi had asked to see some debt numbers. So this is new information. It's a lot of information. I'm not trying to be too detailed here, but I just want to give you an idea of what our debt profile looks like. And then I'll look for feedback from you over time on just what's helpful, what's not helpful, what you'd like to see here. But I'm going to start in the upper left with just a little bit of history. So this is our profile at the end of May. So we were first given the ability to borrow on a district-wide basis in the early 2000s, and our first district-wide bonds were issued in 2004. We've derived that borrowing authority from the voters. So we have to go to the voters whenever we want bond authorization. So since 2004, this would have been probably April of 2004, voters have authorized almost $3.9 billion of debt authorization. We have actually borrowed about $3.4 billion. This is in that first column in the upper left. About $3.4 billion of that $3.9 which means we have $442 million of bond authorization remaining before we'd have to go back to the voters for more authorization. Roughly a little bit more than half of the borrowing is under subordinated bonds, and half of that is the fluidized bed incinerator project. That's generally a cheaper form of debt. It's either 20 years instead of 30 years, so there's savings by not having those extra 10 years to pay. Or for the large loans we have that are 30 years in the SRF, they are a much lower rate. All the SRF loans are at a subsidized rate to what we'd get in the capital markets. So we like to have more subordinate bonds, but it's just not as deep a pool as capital as the capital markets are, where our senior bonds come from. So it is not feasible to get all of our borrowing from the SRF market. All of the money on the senior bonds has been drawn. By definition, as soon as you borrow it, it is considered drawn. The subordinate bonds, which are SRF again, we pay the expenses and then we submit the a funding request to the state, and then they reimburse for those bonds. So we're still drawing. We still have about $500 million more to draw. That number should be 519 instead of 520. We made an update here and didn't update all the way through, but we still have about $500 million to draw on the SRF loan. The bulk of that is on the fluidized bed incinerator project, which is a $900 million project. So altogether, we have over $2 billion still of bonds outstanding. And then in the bottom right, the debt service on existing debt, that $2 billion is reflected in the blue part of the chart. The orange is interest and fees. The blue is principal that'll get paid back over time. That just tells you where we are right now. So even if we did no more borrowing, we're at roughly $150 million of debt service expense the next couple of years, and that's going to head up toward $175 before it kind of flattens back toward $150. I added that green line. That is when the consent decree ends. So all of the major projects we still have yet to do, we would expect to be, completed around there. I don't know what the future holds, but we still have roughly 12, 13 years of the consent decree left. So there will be a lot more capital to spend. There will be more borrowing. So this is where we are today. It's not what actuality will look like, because we'll have more debt that we'll add. So back over on the right side, I just want to go through some debt metrics. And what I've got here is kind of a comparison to the rate proposal from 2023. This was projecting our needs for rate revenue from 25 through 28. So we're almost halfway through that versus kind of what we like right now where we're projected to be at least at the end of the month. So net revenues is our operating revenues minus operating expenses. We are running ahead of the forecast. So we've collected a little bit more revenue. Most of that has been from commercial customers. We have had more interest expense because rates have been higher than we expected. I'm sorry, more interest income because rates have been higher than expected. Debt service, another major component that we have to collect rates to cover, has been lower than expected. The main reason is because we have gotten record levels of funding from the state revolving fund. We have gotten the 2 largest loans they have ever given. We've gotten the first 2 30-year loans that they've given. They used to only do 20-year loans, and it's at a subsidized rate. So that, as you may recall, the funding on the fluidized bed incinerator over the life of that project is roughly $400 million less than what we had originally forecast because we were able to get the state revolving fund loan. So our debt service coverage much higher than what we had projected. So we built in trying to cover debt service. That would be this net revenue over debt service of about 1.8 times. We're actually at 2.4 times. I'm going to talk a little bit more about that in a second. Authorization remaining, we haven't borrowed quite as much as we thought by now, and that's just a function of capital spending not being quite as quick as we thought, but we will catch up. Capital funded by debt, we've committed to 60% of the projects being funded by debt. We're at about 55% right now, so on track. That's just some timing differences. Again, that number swings around a bit. And then DCOH is days cash on hand or liquidity. This is another common metric used by rating agencies and investors. We target to have 550 days of cash on hand. That means 550 days of operating expenses available so that if we had a disruption in operation, in receiving revenue, or if we had a major emergency that required more cash than we needed, that gives us kind of what our cushion is to continue operating. We are currently higher than that, so this is really a function of our unrestricted cash expressed in number of days of operating expenses. We're at 643 on short-term cash and investments, meaning maturing in less than a year, and 803 if you look at the whole portfolio, 803. Now those numbers are higher than target, as is the 2.4, but they are in line with the medians for entities with our credit rating. So if you look down at the water and sewer medians, and these are not the only financial metrics that investors use or the credit rating agencies use, but they're 2 of the most cited to give a snapshot of credit quality. AAA, or the typical or median AAA firm, is actually about 2.7. That's even better coverage than what we have. Days cash on hand, 738. That's in the range of what we have. A AA rated entity, and I think we would mostly be considered a AA, high AA rated entity, is about 2.3 and 649. So we are right in line with those medians, and that's where we're rated. A single A, which is a lower credit quality, we would expect to have some higher debt expense if we dropped and not have as many opportunities potentially with the state revolving fund as well, are even lower. And I will note, though, that our targets, the 550 days and the 1.8 times coverage, are closer to single A than they are double A. So I do not think we are being overly conservative by targeting where we're targeting. It's just the way things have played out with getting the large loans from the state revolving fund. I think, I'm guessing some of that revenue change is because we are seeing, we always have to estimate how much water volume there's going to be because we set our rates based on water volume. Water volume has not declined as quickly as it has in the past, so that's a function, that's one of the inputs for why we would have some higher net revenues than expected. So all those things have kind of come together to put us, where a AA entity would be expected to be. But I think our targets, though, are aggressive. Like I noted, they're closer to actually a single A rated entity. And then at the bottom is just some comparison points. I'm not really trying to compare us to the city or county. It's just for context. We are a large entity. We have more debt than the city and the county combined. Our credit quality is very good. We are actually higher from S&P than the other 2 entities. We're just 1 notch lower than the county for Moody's. we're higher than the city. Most of their debt comes from the airport. Again, that's not supposed to be a comparison saying we're, better or not better than either of those two entities. That's just for some context to kind of show where we stand versus some other local entities. So that's a lot of information, but the debt profile is important to our overall, the way we operate. We only borrow for capital projects. We don't borrow for operating expenses or for working capital. So this is going to be something we talk about as we move into the next year and the new rate proposal. Debt is going to be a primary focus of the rate proposal. It always is. It's always a focus of pushback from interveners or somebody else asking if we shouldn't or couldn't do something different. Should we issue more debt? Those are conversations that we're going to have. Debt helps us spread out the cost, but it still adds costs overall. And more importantly, it adds fixed costs. So we did an analysis the last time that we did a rate proposal. We could have lower rates in the immediate period following an increase in debt, but it would lead to higher rates going after some period of time because of the added debt expense that gets added. And that's a fixed cost. That's not something we have any flexibility with once it's locked in, until or unless there's opportunities to refinance or refund it. So a lot of information on debt, probably more than what you bargained for when you asked for that, Trustee Wabi, but
No, I think this is, honestly, this is very, very useful.
okay, good.
Quick question. We, with the rating agencies, I mean, none of our debt is rated.
The
correct?
senior
As
bonds
I
are rated.
understand. The senior debt, okay.
Yeah, so the
So,
subordinated debt from the SRF is not, but I will say that our high credit ratings are a reason that we get so much support from the state revolving fund. We're the largest borrower by far from the state. And the fact that we are high credit quality, I think, gives them comfort in giving us loans, because we're kind of like an anchor borrower. Because all the debt and principal and interest we pay and fees go back into that fund or to them to help run the program.
Okay. Well, I want to thank you very much for this report. I think this is going to be really useful going into the next year, certainly around the rate commission's work.
Okay, very good. And if there's something else you'd like to see or something different, please, anybody, just let me know. And that is all I have for the Finance Committee meeting, Trustee Evans.
Okay, thank you. So next tentative meeting date is June 30th. Can I get a motion to adjourn, please?
So moved.
So move. Second.
Thank you.
We will get set up for the stakeholders committee meeting here. Trustee Wabi, would you mind leading the committee meeting with Trustee Nikozison being absent?
No problem.
Trustee Wabi, I believe we are ready to go.
All right, I'm gonna call together the 202nd meeting of the Stakeholders Relations Committee of the Metropolitan St. Louis Sewer District. Can I get a roll call?
Yes, trustees Kistner and Carrington are present in the room. Trustees Wabi, Watson, and Evans are present online.
I have no comments. Can we approve, let's see. We're gonna approve the meeting minutes from the last meeting.
So moved.
So
Should-
moved.
Okay, thank you. Agenda item, am I doing this or, sorry? Resolution 4025.
Yeah, thank you, Trustee Wabi. Bess is out at a conference, so I'm going to cover this for her. Resolution, I'm presenting Resolution 4025. It's for public engagement services, and it's, I will be asking the board to approve this resolution, which renews MSD's contract with Standpoint for the second of 3 one-year option years for public engagement services. The services that Standpoint provides us, they do all of our customer satisfaction polling from both billing and field service standpoint. They help us with our communications related to our capital program and other initiatives, and they help us keep our ratepayers and stakeholders informed as we continue our long-term infrastructure assignments. The renewal is budgeted through the executive director's department budget for next fiscal year, and the amount is $350,000. So this will be, the original contract was approved in June. The first option year was approved last year, and we're asking for approval of the second option year for this contract. Are there any questions? Thank you.
The next agenda item is Resolution 4024. Who's going to take this?
Good morning, trustees. This is Jason Stockman. I'll be taking this one. This is for the renewal of the data center hosting, where we have all of our servers and assets in the data center. It's with Regis Commission. We've had them for a number of years. Last year, if you recall, we extended this for 2 years so that we could continue to look into moving more of our services into the cloud. We're continuing to look at that option. However, we would like to renew for this option year 6. The amount's roughly $334,000. That actually went down from last year because we were able to reduce the footprint that we have as far as the number of racks that we required from Regis. If there's no other questions, that's all I had. Thank you.
Thank you.
I'm up next, Trustee Wabi. I've got about 4 items, so.
Thanks, Todd.
Sure thing. The first item I have concerns insurance. You'll recall last month I presented the long schedule of all of our policies. Well, out of all that, we happened to get the name mixed up. So we're pulling that ordinance from the consent agenda, and we are instead substituting in its place for this month for intro and adoption, ordinance number 16603. This ordinance will authorize the district to procure that third layer of excess liability coverage from a company, Accredited Specialty. I think the one last month had HDI Specialty. So sorry about that, but we'll get it corrected so that we're on course to have the renewal in place July 1. Next, trustees, we are presenting at the June board meeting a new lease of district surplus property. It's actually a carryover of an existing lease. I sent you all the lease itself. It's for real property that we own at Union and Hoffmeister along I-55. It has been used and leased by us and used as green space as a recreational bike park with ramps and trails. It was originally operated, going back as far as 2002, by Gateway TrailNet, and it is part of and along Grants Trail. Back in the 2010s, the lease was taken over by a not-for-profit, St. Louis Bike Park, Inc. They maintain adequate liability insurance on the property. They provide indemnification. They operate the park responsively. They require waivers. They have staff on site. And we are asking the lease that we have currently has reached the end of its life. So it will be a new 5-year lease. It's a 1-year lease with 4 one-year renewals. And we're asking the board to authorize us to do this. The property floods. It's along Gravois Creek. It is not useful in any way, and it's green space, and people seem to really enjoy it.
Question, did we ever consider just selling it rather than leasing it, or do we need to maintain it, retain it?
Yeah, it's really not developable, and we would not, you mean sell it to the bike park?
Yeah, that have,
I've never explored that with them, Trustee Kistner. We could,
is there any advantage to retaining it?
well, at the same, we may need access to it at times, to some of the structures, but I will look into that and see if that might be a viable option.
I don't know, just a,
No, that's,
To your point, we try not to accumulate excess property, and we do at times review what we have and try to see if there's someone that is interested in it. Like Todd said, this one just happens to be in a floodplain, and there hasn't been a lot of interest, but we'll certainly pursue that.
next I've got authorization for us to exercise an option for our contract for federal legislative services with our lobbyist in Washington, D.C., Cardinal Point Advisors. We procured this contract. We've used Cardinal Point for a number of years. We pay them $75,000 a year to arrange meeting and to promote our interests with our local representatives in Washington, D.C. That contract has 4 one-year renewal options. We are exercising the second of those options. Finally, we've got our legal service contracts. In 2024, the board approved ordinances for the district to use 5 outside law firms for legal services in various areas when required. The contracts are with the law firms Thompson, Coburn, Quarles and Brady, Helmick, Hill and Redder, White, Coleman and Associates, and Renierson, Seuss, Champion, and Schnurbush. Those contracts, as approved, were one-year contracts with renewal options. This month, we are asking the board to authorize us to renew each of those contracts for the second renewal year out of a total of 4. Any questions? If not, those are the matters I had. Thank you very much.
Can we, can I see the agenda? Thank you. I'm going to ask for to go into closed session to discuss personnel actions under revised statutes of the state of Missouri, 610.021.3, and legal actions. Thank you for making it bigger. And legal actions and causes of actions, litigation under this similar section, paragraph 1. Can I get a motion?
So moved.
Second?
Give us a second here.
Aye, we did.
We got a second. Trustee Carrington.
Aye.
Trustee Watson? Sorry, Trustee Watson?
Yes.
Trustee Evans?
Yes.
Trustee Wabi?
Yes.
Right, we're in closed session.
All right, give us a minute to clear the room, and then I'll let you know when we can get going.
How we doing in there?
All right, I think we're set to go.
All right. Todd, you had some issues first.
Yes, actually, Rich Unverferth and Alan Mueller from engineering are going to lead us off on the matter we're discussing that's under the litigation exception.
I thought we were done with Rich.
Not quite yet. There's no action first from the trustees today, but we wanted to circle back on an issue that was in closed session 2 other previous times in late 2023 and then in 2024 regarding some claims that we had during the construction of our Lower Merrimack wastewater treatment plant. You do have some handouts. One of the handouts is a photograph of the plant. And
Hold on just one second, Rich, sorry. We have an intruder.
Where are the hands? to bring the committee out of executive session?
So moved.
Second.
Second.
It's moved and seconded.
right.
We will, we're now out of closed session. Can I get a motion to adjourn?
We don't need a roll call to come out. We don't need a roll call to come out, just to go in.
Did we get that?
We got the roll call vote to go in the closed session, yes.
Okay. Okay. All right, then with that, we will, I'll entertain a motion to adjourn the meeting.
Motion.
Thank you, guys.
Thank
Have a
you.
good day,
Yeah,
everyone.
thank you, everyone.